There are deductions inside of the tax code that are completely legal, fully available to you, and almost never discussed because the less you claim, the more the government collects. Here are 5 of them. Hi, I'm Alex Rivera, the owner of Ceiba Accounting. We help small business owners build real tax strategy, not just file returns. And today, I want to walk you through the 5 deductions that your clients use every year that most business owners never hear about. None of these are loopholes, none of these are aggressive or risky. They're written into the tax code and they are yours to take. All right, let's go. Deduction number 1, your health insurance premiums. If you're self-employed or you own your business and you're paying for your own health insurance out of pocket, those premiums are fully deductible as an adjustment to your income. We're talking about medical, dental, vision, and even coverage for your spouse and your dependents. These deductions comes directly of your gross income before you even calculate your tax. And yet, every year we meet with business owners who have been paying for these premiums for years and never claim it once. Stop leaving that money on the table. Deduction number 2. Vehicles. If you use a car for business, for your client meetings, for site visits, for supply runs, any expense related to that vehicle is deductible. And you have 2 choices. The standard mileage deduction rate, which for 2025 is 70 cents per mile, or the actual expenses, gas, insurance, maintenance, depreciation. Here is the thing that most people don't know. Whichever method you choose for that vehicle in the first year that you put it in service for your business, it locks it in for you for the remaining life of the vehicle. So if you start with actual expenses, you generally cannot switch to mileage later. And if you ever claim depreciation or 179 deduction on your vehicle, mileage is fully off the table. That's why this decision needs to be made deliberately with your accountant before you file your first return for that vehicle. It could mean thousands of dollars over the life of the vehicle. Deduction number 3, and this one surprises people every single time. Business meals. Yes, business meals are still deductible, 50% only when there is a genuine business discussion taking place. The key documentation for you to take this deduction is that you need to record who you met with, what you discussed, and keep the receipt. Now, I want to be clear. Entertainment expenses, tickets to games, concerts, a golf outing, those are not deductible anymore. That changed with the 2017 Tax Cuts and Jobs Act, and it still applies today. But a working lunch, a client dinner, a breakfast meeting, those are 50% deductible that you can claim. If you're not tracking this, you're leaving hundreds or even thousands of dollars on the table every year. Taking the photo of the receipt with a quick note takes 10 seconds and saves real money. Deduction number 4, education and professional development. Any course, certification, book, seminar, or coaching program that maintains or improves your skills in your current business, these are fully deductible. The key word is current. This deduction applies to education that makes you better at what you already do. It does not apply to education that qualifies you for an entirely new career. But within your field, that mastermind you joined, that industry conference you flew to, the book, the courses, the coaching, all of that reduces your taxable income. And most business owners I talk to have never once put these on their return. Deduction number 5, bonus depreciation. Most people have heard of Section 179 deduction, but bonus depreciation is the more powerful tool and almost nobody talks about it. Here's how it works. When you buy equipment, vehicle, machinery, or certain other assets for your business, the IRS normally wants you to depreciate that cost over several years. Bonus depreciation lets you deduct the entire cost immediately the year of purchase. And here is what makes it fundamentally different from Section 179. Bonus depreciation can actually create a loss in your business. Meaning, if you had $200,000 in net income that year and you bought a $250,000 qualifying asset, bonus depreciation can push your taxable income below 0. Section 179 cannot do that. It is capped at your business income and cannot generate a loss. That loss created through bonus depreciation can then potentially offset other income you have. This strategy changes the entire conversation around the year-end planning. The bonus depreciation rules have been changing. There was a phase down before 2025. However, after the law changed in 2025, bonus depreciation changed back to be 100% deductible indefinitely until they change it again. These are the significant changes in the law that your accountant needs to walk you through before December 31st, because timing of your asset purchases and how aggressively you depreciate them can dramatically change your tax picture for the entire year and potentially beyond it. So here's the truth. Every one of these deductions is sitting inside of the tax code right now, waiting for you to claim it. But you have to know they exist, you have to document it properly, and you have to work with someone who is paying attention all year long, not just at filing. And that is exactly what we do here at Ceiba Accounting. Go to ceibaaccounting.com and let's talk about what you might need this year or what you might be missing. Subscribe for more content like this every week and share this with a business owner who needs to see it. I'll see you in the next one.